Good afternoon, everybody. I'd like to thank you for joining us today for 1 year of COVID. What has changed? We'd like to review what has happened over the last year, what was expected, what was not expected, and also what we think is going to happen going forward and what the market tells us. Just a brief overview of the table of content. Schwab and Cabell Group, just a brief introduction, who our colleagues are, key elements of what has happened over the past year, the stock rally to remember, the inflationary threat, the inflation, what is the CPI in the US is telling us, bond yields since 1982, how do they compare to earning yields, earnings a primary driver to the rally, the big picture on the GDP front, unemployment, the manufacturing service sector, purchasing manager index, government policy, and creating market cognizant portfolio. What should you be looking at? Really, that's your takeaway at the end of the presentation. Meet the team. I've been in the business for over 30 years. I've worked for a number of larger financial institutions, RBC, BMO. I worked for some boutiques, and I've also run a family office before. Managed a family office for a ultra high net worth individual. Martin Hafley is my co-founding partner. He's also a successful entrepreneur, also partner at Hafley Co KG, which is a family enterprise with officer with 40 countries around the world. He does our ultra high net worth estate and financial planning. And he's also very familiar with family conflict resolutions from his own experience. And Hamza is our Vice President and Associate Portfolio Manager. He's a former equity and research analyst and investment banking associate. He's worked in the Middle and Far East. He's joined us about a year ago, and he's been an absolute wonderful addition. If you ever meet him, you'll enjoy his company. What are the key elements to what has happened over the past year? So the couple of markets, we're going to talk about the bond market, the stock market, we're going to talk about the real economy, the GDP, employment number, inflation, purchasing manager index, what was a government policy, monetary policy versus fiscal policy, and then we'll talk about what we expect going forward, and we're going to talk about some of the sectors, service sector, retail shopping, remote working, and healthcare. Stocks, a rally to remember. The last year has been absolutely incredible. While the pandemic nearly shut down the world economy, an unprecedented policy response kept the economy afloat, leading to the shortest recessionary decline in the steepest stock market bounce in history. By Jonathan Golub, Chief U.S. Equity Market Strategist at Credit Suisse. My own comment here is really, we were in a situation similar to what we were in the 1930s, where if the Fed and the US government would have taken on a very restrictive policy, we may have gone into a depression here. That is how severe this was. However, because they had a very accommodating monetary and fiscal policy, the stock market has done absolutely incredible, and as you'll see later on, even the entire economy. The very interesting aspect on this whole equation, you can see on one hand, this is a chart, the blue line is a chart of the S&P. It reached a high of 33.86 before the pandemic. It reached a low of 22.33 on March 23rd of 2020. And it's now at was a week ago at 41.50. That all along, as COVID cases have risen, the orange line shows the millions of people that had COVID. So at the bottom, at the beginning, we were literally at the onset. We're now at 140 million COVID cases, and even though we have 140 million COVID cases, the market has made all-time highs. What the reasons are, we'll show you in our presentation today. The inflation threat. I should have actually asked you what your thoughts were on the inflation. if you were to guess what the inflation is going to be over the next 10 years, what would you expect it to be? I'm starting the poll. We have a number of options here. If you kindly choose some, and it's not a big deal if you're wrong. I'll show you afterwards how wrong the even analysts and general economists were. Gonna wait for a few more minutes. I think we're almost done here. Leave it another 10 seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right, I'm going to publish your results here. Interesting outcome. As you can see, most people thought the inflation rate is going to be 3%. Some of you felt it was going to be 1.5% or 2% or 2.5%. I guess on a consolidated basis, over 40% expected between 2 and 2.5%, and a few people, 7%, expected 3.5% or higher. The actual next 10-year inflation, break-even inflation expectations as of April the 14th is 2.33%. So about 41% of the respondents have guessed fairly close on here. How do we come to this? What we're using on this, we're using a measure that is really the difference between the yield, the nominal bond, and an inflation index bond. It's probably the best measure of expected inflation as the market is expecting this. If you're just to put you somewhat at peace about your expectations and what you felt was the inflation forecast, you can see over the last year and a half, inflation expectations have gone anywhere from about 0.5%, the middle of last year, up to 2.3%. And it's been all over the place ever since. So if you were wrong, don't worry about it. Christopher Wood, the head of equity strategies at Jefferies, said a sudden surge in demand following a supply shock is a classic recipe for pickup inflation. The result is that investors should be prepared for the biggest inflation scare in America and the reopening of the economy since the 1980s, when Paul Volcker crushed double-digit inflation by imposing high real interest rates. I don't think that will go quite to that extent. In the early 80s, we had over 15% inflation, over 10 or 15% inflation rate. We're definitely not going to get there. But could we see 2.5%, 3% in the short term? That's quite possible. Really, what is driving this inflation? It's the pent-up demand and the supply shortage in many cases because of logistics and because of COVID production issues. This is not likely going to persist after most people are going to be vaccinated. We expect that the supply shock is going to return again. What it's going to look like, and what it may look like, is literally what we've seen 100 years ago. The Spanish flu terminated in the late teens, in the 1900s, and we had the Roaring 20s. We had a lot of behavioral changes. This is the exact same thing that what we're seeing right now. People are starting to work from home. A lot of people have made their home office their main office now. There's companies that allow people to work from home indefinitely. But what will that mean to inflation, and where will we see that primarily? We'll see it in raw materials, copper, lumber, houses, sofas, hot tubs, fitness equipment, garden furniture, bicycles, roller skates, boats, cars, gas, coffee, water, meat and dairy, cheese, seafood, vegetable, computer chips, and personal electronics, really all across the entire board. The only thing that will be disinflationary will be that there's less office space required. and less conferences will take place. So there will be some disinflationary factors, but on an overall basis, there's going to be a lot of pent-up demand, and that's what's going to drive that inflation threat. Inflation, if you just take a look over the last 5 years, where were we? If we measure it by the CPI, which is a consumer price index, a basket of goods that people use, we've seen it from as low as 1.4%, December 19 to December 20. Obviously, that was primarily caused because the COVID-19, but we've seen it as low as 1.8%. Well, 1.8% was the average inflation, and we've seen it as low as 1.9% from December 17 to December 18. But anytime in between there, it's been fairly steady, and the average inflation rate has been 1.8%. From March of last year until March of this year, it's been 2.6%, and economists are expecting, or the IMF is expecting the CPI index to reach as high as 3% between December of last year and December of this year. The core inflation, which excludes food and energy, which is not as volatile, is slightly higher, about 1.9%. As you can see, it's fairly steady, and we're likely to see a very similar inflation this year, from December of last year, December to this year, as what we've seen from December 18 to December 19. So it's nothing extraordinary, nothing to be really worried about, but inflation is definitely going to move up. We'll start up with the bond yields. Inflation obviously is going to impact bond yields, and we've shown you on an overall basis where bond yields were in the early 80s, which is what we've talked about on inflation, and Paul Volcker crushed inflation and increased interest rates. 10-year bond yields were as high as 15.8% in September of 81. And we've descended ever since. And even before COVID-19, we were very low. However, in December, just to give you a bit of a perspective, we've got a bit of a cutout what has happened since October 19 until February of this year. In October to December, we were as high as 1.9%. We made a low on August the 4th, which were at 0.5%, and ever since we've moved back up. We're now at about 1.5%. We were as high as 1.75% as of March 31st. So we've really returned, and higher interest rates and higher bond yields is basically going to show us if the bond market really expected much higher inflation rate, we'd see much higher bond yields at this point. So I'm not overly concerned on a long-term basis, but it will definitely go. There's nowhere else to go but to go up on interest rates. The reason I've brought the other one up was also to compare it to earning yields on the S&P 500. So there's a fairly high correlation between 10-year bond yields and earning yields. It's about an 80% correlation between bond and 10-year bond yields and S&P 500. Now, you can see they're fairly steady, but we've had a prolonged period where the orange line, which is a Schiller PE earnings yield, the inverse really of the price earnings ratio, has been quite at a discount to government yields. And then we had a period where they were fairly steady. They were tracking fairly much similar along at the same line, and now we're actually at a premium. And that's just on a side note. What I've really noticed is that in 1984-85, which we went on discount, was really the period when relations between the U.S. and the USSR started to stabilize, and it was really the beginning of the end of the Cold War. So people were more euphoric. They were obviously quite happy that we didn't have the Cold War overhang anymore, and that is what we've seen. In 1999 and 2000, we had the decline of we had the collapse of the technology market. And that's really what we're seeing here. From 2002 to 2008, we had a very accommodative government policy and monetary policy, fiscal monetary policies. And then after 2008, it came back to more restrictive regulations, which caused government earning yields to be at a premium to bond yields again. But we're just trying to show that there's a fairly high correlation here. And where we're going with this is we like to show you what the main driver is of the stock market rally. It's not that people are going ballistic and they expect that they're buying stocks at insane prices with no fundamentals. Even though we've seen, as you see in the bottom right-hand chart, earnings multiples have moved up, and those are the forward earning multiples. They've moved up from 18.2 on the S&P 500 to about 22 currently. That's really a function of what we've seen over the past year in earnings. As you can see, over the last 5 years, earnings surprises on the upside have been fairly steady. They've been as low as 2.9 and as high as 7.5%. It's somewhat of a range, but it's not overly volatile. What is absolutely surprising is what we've seen over the last year. The second quarter of 2020, earnings had outperformed expectations by 23%, 19% in the third quarter, and 17% by the fourth quarter. We're not done. All the companies haven't reported the earnings so far for the first quarter of 2021. However, so far, earnings have beaten expectations by 35% so far. So far, we've had about 20% of the companies releasing earnings, so that will likely be moderated. So this is really just an indication that this rally is real. This rally is not by some consumer and investor exuberance. There's real fundamentals behind it. So I would not be very worried about the market being collapsing or correcting anytime soon. The third chart that we've shown here is just another measure of how we can substantiate that earnings are real and that this market is real. It's somewhat of a complex methodology. It uses the BBB rated bonds, the inverse of the BBB rated bonds, and it compares that to the forward and to the treasury yields. So far, we haven't seen any change on that since June of last year. June of last year, the BBB rated bond on average yielded about 3.8%. This was made up by 0.7% on the government bond yield and a 3.1% spread, which is really the risk premium that people want for government for corporate bonds, BBB rated corporate bonds versus government bonds. We're now still at the same, even though 10-year treasury yields have moved up by pretty well 1%. However, the spread has declined by 2%. It has narrowed. That means people are much more willing to accept corporate bond risks than they were a year ago. The big picture, where are we in the GDP? The US economy shrank by 3.5% in 2020. It was 0.2% more than what the global economy shrank. The global economy shrank by 3.3%. This was the largest annual decline since 1946, after the Second World War, when the economy shrank by 11.6%. Back then, it was really a restructuring of the economy, and the entire war machine had come to an end, and the entire economy had to restructure, and that is what caused the decline. This time, it was in the pandemic. We don't have the numbers for what happened in 1919, but it would have been an interesting comparison. The US growth in 2021 is expected to be 6.4%. Declined more than the growth, but it's also going to increase more than the growth. The global economy is expected to expand by about 6%. It's been the strongest since the 7.2% expansion of the economy in 1984, post the recession, when Paul Volcker raised interest rates. The U.S. growth in 2022 by IMF is expected to be about 3.5%. So we're basically moving back into a more normal session. However, the U.S. is expected to be the only large economy projected to surpass the level of pre-COVID expansions prior to 2020, when the expectations were about 2%. You can see in the first quarter of 2020, we contracted by 5%. The second, we contracted by 36%. I'm sure everybody still remembers when we had the lockdown and everything had come to an absolute standstill. The third quarter, we expanded by 30%. In the fourth quarter of last year, we were up another 4%. And that, on an overall basis, should translate for 2021 an expansion of 6.5%. The employment, what is happening on the employment front, and what should we take away from that? Unemployment was as low as 3.5% before the pandemic, both in January and in February. This was the lowest unemployment rate in over 50 years. In March, it increased slightly, even though the pandemic had already onset. But in April, when the economy came to a screeching halt, we reached 14.7% inflation rate. I'm sure everybody remembers a lot of service personnel were laid off. Even in the manufacturing, there were layoffs. So it was catastrophic, as I'm sure everybody remembers. What has happened since? Well, we've gone from 14.7% down to 6%. And if you take a look at the 20-year average, this represents about the unemployment rate over the last 20 years. The only difference is that currently even though the statistics show us 6%, it's much understated because there's a lot of discouraged people that are not even looking anymore, because they're not looking, they're not counted. The real unemployment rate could still be 10% or higher. But what we can also see there is we're getting a structural change in the employment situation. We've had a significant increase of productivity due to technology. We're about to surpass companies are making greater profits, and we're about to surpass the economy where it was pre-pandemic. So that means there has been an incredible increase in productivity. All we need to look at is that Zoom technology and a number of other technologies that we've used in order to make things, to achieve things with a lot less transportation and a lot less input. That will require, however, a significant amount of retraining for a number of unemployed people right now, because they may not be suited anymore to the current economy. The real economy. So unemployment is really a lagging indicator. What does really a leading indicator tell us? The Purchasing Managers Index, composite index, is really a leading indicator. What it measures current and future business conditions as it is expected from purchasing managers. What it consists of, it shows the new orders, inventory levels, production, supplier deliveries, and new employment plans. That has reached the highest level since 1983 of 64.7%. We can take a look at where we were over the last year and a half. We were never as high, and ever since June of last year, we've surpassed the previous 6 to 8 months. Each and every month of last year, each and every month since of June of last year. So on an overall basis, we're quite positive. Government policy. Where has government policy been and where is it going? Monetary policies, the central bank, the US Fed, has committed to a 0 to 0.25% interest rates, most likely until the mid of 2023. This has been a level since March of 20. The criteria for the Federal Open Market Committee, FOMC, to reconsider its stance would be a full recovery in the labor market rate, an inflation rate that reaches 2%, and it drags to run above 2% for a sustainable period of time. The Fed, as I indicated, they have no plans on raising rates until 2023. The market, the futures market on bonds and the forward market, however, expect that we may have a rate hike as of by December 2022. The fiscal policy, approximately $7 trillion has been spent as a response to this pandemic. The U.S. annual deficit at $3.1 trillion in 2020. This is an all-time high, the higher than we've ever seen before. For comparison, the annual deficit during the great financial crisis was $1.4 trillion in 2009. So we've reached more than twice that level last year. Even in March of this year alone, the U.S. government has spent $970 billion. This is twice as much as what it spent in March of last year. This will result in a monthly deficit for March of $660 billion, the third largest in U.S. history. The first and the second largest monthly deficits were in April of last year and in June of last year. As Mark Edwin, an expert in the Committee of Responsible Federal Budgeting, said, this is going to be a big deficit year because we're already running a substantial deficit and past a $1.9 trillion bill. That is what you expect with a $1.9 trillion stimulus package on top of structural deficits. What does it really mean for us going forward? Let me just briefly do another poll here. And I'd like to get your opinions on that. Do you believe we will be facing a major stock market correction in 2021? Let me just put the poll out here. You kindly choose yes, no, or if you're not sure. So far, even though I thought I made a fairly good argument, a lot of people still think that we'll see a significant correction. I'll leave it open for another 15 seconds, and then I'm going to close the poll and I'll show everybody what the polls were. Ten, 9, 8, 7, 6, 5, 4, 3, 2, 1. Okay, and there is our polls. As what we've seen, 46% think yes, 38% think no, and 15% believe are not sure what is going to happen. I'm still surprised, even though I should have done the poll before I've given you all the answers here. But obviously, there's still a lot of pessimism. Oftentimes, that is actually a good indicator in the stock market to see whether there's a correction or not. There's an old commodity saying that says, when all agree in harmony, it's not long till they're all wrong. And oftentimes, that happens at on top of the stock market. The fact that we have a lot of people that think that we will have a significant correction is actually quite comforting because the chances that that is going to happen are fairly low. You've seen my economic our economic analysis and our outlook, and however, now we'd like to give you our final final slide, where we show you what we think are good strategies to take to position your portfolio properly. We think stocks will do better than bonds during inflationary times. If you have fixed income securities, the good thing is, the best thing would be to transfer to sell your bonds and buy floating rate bonds or preferred shares instead of fixed rate bonds. For bonds, you can also consider TIPS, which are Treasury Index Participation Securities in the US, or in Canada, they're called real return bonds. The other option that we would recommend is considering diversifying into commodity and cyclical stocks. Interest rates, we think there is only one way of going, and that is up. If interest rates are going up, what are good stocks going? What are good exposures? Banks, especially insurance companies, brokerage firms, and money managers. As rates are rising and the economy strengthens, so will consumer discretionary spending. So consumer discretionary spending will be very important. You should look specifically into sellers of home appliances, cars, clothes, hotels, restaurants, and movies. You should also reduce your bond duration. Really what that is, you should reduce the term to maturity. Your bonds shouldn't be any longer than 5 years. Thirdly, the reopening trade. There's still time. Over the past year, a 1-year total return of cyclicals and financial has been 69 and 67% versus technology, which was 63%. But we've seen an absolutely incredible increase in all those three sectors. Where we're rotating into now is into lower PE, value-oriented stocks. They've returned already 11.5% in the first quarter of this year. Growth factors, sales growth, company growth stocks have declined by 3.4% during the same period in the first quarter of this year. Energy, material, and industrial companies are cyclicals. Those are definitely companies that we think you should consider having some exposure to. High growth, beware. High growth, we're talking about technology. In 2020, the absolute insane growth of technology companies has created valuations that are not sustainable. Those companies that we're talking about, maybe Amazon, maybe Facebook, maybe Zoom, and others. While as long as their growth continues to exceed expectations, they will do well. But a number of companies, especially companies like Amazon, that has benefited incredibly during the pandemic because everybody started buying online, may actually suffer in a return over the next year or two. As long as over the long run, we believe technology companies will do well, but may experience short-term pain. As a good idea to rotate from growth into value stocks. If you want to hold any technology stocks, make sure that the fundamental is sound and that they're not overvalued. That is really all. I have one last poll that I'd like to indicate, and that's really how would you rate this webinar today? If you'd kindly give us our feedback, that would be very much appreciated. And if you have any questions, please enter them into the question and answer section. One individual said, what do you feel about buying technology as buy and hold strategy? Isn't this a good time to buy when everybody is selling? We may have not quite seen a bottom yet, but I think there's a lot of opportunity. Otherwise, I have taken that stance in RESPs or in portfolios that have a very long hold, I've actually purchased a certain amount of good quality technology stocks. Just to go back here again, let me take a look at the results. We appreciate most people seem to have liked our webinar today. We'd like to thank you. We hope to see you in our future webinar, which we'll likely do in another month or so. And next month will be on a specific topic again, rather than on an overall market overview or economic overview. Thank you very much. Stay safe. And if you have any questions, you can call me at 416-477-7216, or you can reach Hamza, very nice guy, 416-477-7217. We'll be sending everybody that has attended today the webinar or the presentation. And if you have any questions, please reach out to see us. Thank you very much.